big macro charts. You've seen this before, and I'm going to remind you again constantly because I don't see this anywhere on YouTube or the internet. No one is looking at these charts combined. So the first chart is the Fed funds rate. We all know that rates have gone up quite a lot, so probably the fastest rate in history. And what we can see just from this chart alone is that every time we have a major hiking in rates over a short period of time, what happens? We have a recession. These grey zones are stock market crashes / recessions. Nearly every time we have crazy spiking of rates, it's a big deal. Now, again, I've said this before, most people go, oh yeah, but Siam, look at this in the 80s and 90s, we had double-digit rates. Yes, but look at M2 over that period as well. And look at GDP to M2, like it was nothing. M2 has done this. So the US is now about to spend $1 trillion a year on interest payments only. That's about a year ago, that's 250 to 300 billion. It's now $1 trillion.
Is that retail or government?
The US government is spending $1 trillion a year. And to put that into perspective, they only take in about $4.5 trillion in tax revenue. That's nuts. So that's like, imagine you take home £2,000 a month from your job or whatever, and you have to pay 500 quid a month on interest-only repayments. Sorry?
Got it by the rest of us.
Yeah, just like the yeah, exactly. Yeah. So
are those official recessions, or are those calculated as this is a recession if the statistics are intact?
I don't know the honest answer. This is from the Federal Reserve website. Whoopsie. So, oh yeah. So these recessions will be the original definition of a recession, which is 2 quarters of negative growth. So, yeah. So technically, until the White House changed it last year, a recession is 2 quarters of negative growth, and then every quarter you have negative growth. It then expands the grey, and so here that's going to be what, the best part of 4 quarters of negative growth, something like that. So yeah, every time we have a sharp spike in interest rates, be prepared, and that's what's going to happen. But you can't just base your investing decisions from one chart. So let's look at another chart. Same chart here, but with unemployment rate. Now again, if you agree with my stance, I think it's total bollocks the way that they look at unemployment. But just looking at this chart, every time unemployment hits relative lows, guess what happens? It's just before a recession. Low, crash, low, crash, low, crash, low, crash. Almost every time you have a local low in unemployment rates, guess what? We have a crash. And right now, it's pretty much the lowest that it has been since the late 1960s. So again, the unemployment chart shows us a crash is inbound. So now we have 2 major macro charts showing shit's about to get real. Then you add another one, which is inflation. Historically, every time, or really not every time, really from sort of the 1990s onwards. Mind you, here, so inflation rallied hard, crash in the 70s. Inflation rallied hard again, crash again, 1974-ish. Actually, almost every time, yeah. Inflation rallied hard again, mini crash here, and so on and so forth. And guess what's happening right now? Where's that chart gone? Yeah, inflation's up here. So inflation is growing faster than it has been for, almost 50 years. So for me personally, when you look at all these 3 major macro charts together, they're all saying the same thing. But this time it's different, Siam. We've got AI. Nah, bollocks. I still think a crash is coming. And for me, looking at my crypto pot, that's the one bullet I just don't know how it's going to affect. Like, I've always been a firm believer that diversification is for people that don't know what they're doing, and you should concentrate your time, focus, and energy on your particular niche and basket, and then have a nice fuzzy peripheral of the world. Always looking for that bullet. Now, for me, I see a bullet heading towards my crypto pot, and that bullet is the big crash, the banking crisis, etc. And so the thing I can't fully compute right now is how is it going to affect crypto. My best considered answer so far, and it may change, is that I think it will temporarily affect crypto, as in it will, like if the S&P dumps 20% overnight, what's crypto going to do? I think it's also going to dump probably 20, 50% overnight with it. But where my thinking diverges from other people is I think Bitcoin will then completely disconnect. I think people will go, oh my God, all my stocks, bonds, pensions, everything's in the gutter. And the government's going to probably start printing like crazy when that happens. Everyone will go, well, shit, where do I put my money? Can't keep it in cash because they're now printing. Fuck it, let's just go into Bitcoin. And that's where I see the disconnect happening. And we've seen Bitcoin disconnect from the main markets quite a few times now, small to begin with, but I think Bitcoin will be the big disconnect. And then obviously if Bitcoin then disconnects from risk on assets like stocks, then everything else will probably follow. So I think it's a risk I'm willing to take, and that if we, let's say tomorrow morning, the S&P dumps and crypto dumps, don't sell. That's my only, not financial advice, but friendly recommendation. Just sit tight, because I don't see a universe where Bitcoin goes to zero. And I know that's very foolish to say that. I don't want to jinx it, touch wood. So
during a recession,
yep.
Are the interest rates usually go down or up? The reason I ask that is because the US really wants them to go down if they're going to be paid up those loans.
Yeah, so there's two things here. A lot of people think that the stock market is the economy. It's not. The stock market is, the stock market is a forward projection of what people think is going to happen in the future, but underlying that, the economy moves a lot slower. So when you see these recessions here, this is just, again, 2 negative quarters of growth. But the economy, I think, lags quite a bit. So this is why this is why the charts don't make sense, because you're like, wait a minute, if employment was so good, as in unemployment was so good, why is there a crash going to happen? And I think the reason being is that there's a certain lag here, because how do I explain this properly? I'm just trying to think. Well, take inflation, for example. Inflation spikes up, that hurts everyone, right? We as people have to spend a bigger percentage of our income on food and groceries and energy and just to live. And countries and governments are exactly the same. So if everyone starts spending a high percentage of their income on living, that means there's less money to be allocated into investments and fun stuff and whatever. Therefore, GDP gets a hit. And therefore, everyone contracts. We go on less holidays, we buy less cars, we do less things. And because of that knock-on effect, not just for little plebs like you and I, and we are the plebs, really, in their eyes, obviously, it's the same for governments. And therefore, it's that slow turning cog that means eventually we're in a crash. But obviously, stocks are not representative of that. So did you have something to say? Oh, no, sorry. So that's interest rates. That's inflation. Interest rates, the reason we have a crash because of that is because, guess what? It's exactly the same reason. Higher rates means people have to spend a higher percentage of their income on debt repayments. And because of that means we have less money to spend on other bits and bobs, therefore GDP goes down, etc. And it's the same with government. So this next chart is total federal current expenditure interest payments. So this is the US government touching $1 trillion. It's insane. So this is 2020. It was about, oh sorry, I got the wrong earlier. 2020, they were spending just under 400 billion a year, just as interest, and it's now gone vertical. Almost $1 trillion. Give it, I don't know, a couple of weeks, that'll probably be $1 trillion. Or probably a month or two. And by the way, I don't see this ever coming down. This mathematically, it can't go down. If they're about to do $2 trillion raise over the next 2 quarters, what happens to this? This is nuts. So yes, Chris.
Is there a version of the previous chart which is actually about, so that each of the data points is about change? The point I'm trying to make is if you've got interest rates going from 1% to 3%, that is massive.
200% change. less.
It's not significant, and that might be part of the issue about unemployment there. When you get used to that,
Yeah, that's the rate.
it becomes who you are and what you are in the society you are, whether that be global or local. But if you are changing to that and you've suddenly got there,
Yeah.
as you see, that's where it hits.
This is why I think, schools should teach charting, not for crypto or whatever, but just chart and stats a lot more to kids, because like your point is completely correct, because you don't know, or you need to be able to distinguish the difference between an absolute figure and a relative figure. So unemployment rate is a relative figure, but if I were to redraw real unemployment in absolute terms, it will probably be, let's say take this crash here, it'll be unemployment, mass unemployment, crash. No, I think it'll be rising unemployment into the crash, and then the crash happens, and it will probably spike a lot more, because during a big crash, companies go bust, everyone gets made redundant. So I think the real absolute unemployment will actually lag the actual recession bit. So yes, unemployment rate is a lot different. And then, so here's the interest payments. Now,
So,
yes?
Is there anything different about this time than the other ones that you think? I know you said, it really differs, but is the printing of money, is the QE different enough to make it behave differently? Or is there anything that you've come up with that you think actually it's going to behave differently this time?
I think it's a good point. Because for me, the big imminent crocodiles or big variables are AI/bipedal robots. It's not on people's radar yet, but that's a 5 to 10 year play. I think to have real crazy change, AI and bipedal robots, that's let's say 3 to 7 years. And that's when that will be very bullish for the economy. So that's not really a player until then. Then we have the banking crisis. This is, that gangrenous limb that just needs chopping off. And I think that will happen, that will coincide with CBDCs being launched, because CBDCs are not going to be friendly to banks, because there's no need for a commercial bank when you have a central bank issued CBDC. So actually, I do see that CBDCs are a big threat to banks like Barclays, HSBC, etc., because it basically takes their job away, effectively. So that's when I look at things, I don't think things are going to change. I think this next crash, I think will be a lot shorter than most. So people think, it'll be like 2008. Well, no, I think 2008 was pretty drawn out. That was like an 18-month crash with, then they pivoted in 2009 and started printing. I think the crash this time will be a short, ferocious? Yeah, that is a word, sorry. Ferocious drop, and then I think they'll drop rates, print like crazy. I mean, they're already doing that 2 trillion bond raise. And so, I think we'll probably maybe a 20 to 30% S&P 500 crash, and I think it'll V-reverse. And this is where, I wish I had the slides from a bunch of cuddles ago, I genuinely think the latter half of the 2020s, so let's say 2025 onwards, are going to be, or 2024 onwards is going to be really bullish, because we have so the tech element starts getting traction. What else is there? The Fed pump and robots, AI.
So you're expecting a crash before that time?
Yeah.
But you're often early.
Spot on. So fade me, or lag me,
I'm not disputing.
I know, I know. So I could be early. This could, but either way, I think it's spot on, and I say that to myself all the time. When I want to place a trade, I'm like, Siam, sit on your hands. Hey mate, hey Greg.
It's possible they could
There's a chair over here.
kick the can down the road a bit further into the 30s.
I don't know. I mean, could they?
So what was the question?
Could they kick the can down the road into the 30s, as in the 2030s? They could, technically. I think it's slim. I think what's going to happen is that in the US, the parties are going to flip in the next presidency, and the ruling powers are probably going to be like, yeah, let's just dump the market now. Now, because Biden's their friend, as is the establishment's friend / puppet, if Vivek or RFK wins, or Trump wins, they're going to be like, yeah, let's just let the markets dump now. And go, told you. Maybe, the honest answer is I don't know. I think it's slim, yes.
So the shareholders of the Federal Reserve,
Yeah.
they're not going to give up their power because obviously they hold all the cards.
Yep.
So do you think they're just going to inflate the US dollar into oblivion and then line up their CBDC and then just transition everyone onto their next thing and say, oh, well, this system's broken, let's just move on to this thing, which is better?
So officially, no one knows who the shareholders of the Fed are. But when you have a calculated guess, they're globalists. So they don't really give a shit about the US, they don't give a shit about the UK, Europe, etc. They give a shit about global control. So it's likely, again, I've got nothing to back this up, no one has. I think the owners of the Federal Reserve are also the owners of the IMF, the World Bank, they control the World Economic Forum, all that sort of stuff. And this big push for global consolidation of everything, they will have their mitts all over that. So yes, they'll probably own most of the banks, but they know that, yeah, if we kill off the commercial banks, I mean, that they'll make money elsewhere. So it's a hard question to ask, really. I don't see how they can ever lose, though. And by the way, the slow consolidation of power is a bad thing. Like, in our lifetime, I do believe we'll have some sort of one world government, one world currency, one world police force, one world military, one world everything. And guess what? The people that control that one world, whatever, will most likely be unelected officials, just like the European government and the WEF. I mean, the WEF effectively dictates what we do these days, or what global leaders copy them, but they're not elected. So, yeah. But yes, Josh.
So is there not an argument to say that rather than being early, maybe you're late, and the fact that the last 12 months possibly were the recession that you expect to come?
It's a good...
On the basis that other than the top 7 companies, most of the S&P, particularly external growth stocks, down 40-50%. Even the top 7 were down 20-30% at the time, so it's now becoming
true.
to all-time high. So,
but we also see mass surging in stock prices just before we reach recession. So if we were to add the S&P 500 to this, you'd see all-time highs or big surging into it before the recession.
So would that then stipulate that should that hypothesis be true, you'd expect bigger drops than what we've seen in the past 12 months? Because
the whole stock market is 7 companies.
Yeah.
Not have the surge in late 2020 though, with the
Yeah.
Could that not be
True.
identified as a punt that didn't make sense to him?
True. I guess.
Because other than the top 7, we've got some S&P 500 companies that are still down 60%.
Yeah.
So
that's a big draw then.
So my take on all of this is that we're effectively shuffling the deck chairs on the Titanic of when is it going to sink, or has it already sunk, or have we hit the iceberg, when in fact the actual action we should be doing is let's get the hell out off the ship. And getting the hell out of the ship, in my eyes, is crypto. Just if the simplest thing one could do right now is regularly buy crypto, or buy as much Bitcoin. No, let's say the easiest thing the average Joe could do right now is buy as much Bitcoin as they can. Don't worry about any more crashes. And then every month put as much of their spare income into Bitcoin and continually accumulate Satoshis on a regular basis, because that is the oxygen mask to rapid decompression in the aeroplane of global economy. Literally everything Michael Saylor's been saying for the last, 3 years, that is a solution. So whether who's winning or is the stock market going to boom or crash, personally I don't really give a I don't care.
Really zoom out.
Yeah, when you zoom out, it's like, well, why worry if it's going to crash, or if it's going to crash, or if it's going to crash soon? The solution is always Bitcoin.
Just on the other point previously of is this time different with data fields, one thing that is quite pertinent, which I found out a few weeks ago, was that the unemployment data, which is now prevalent, I don't know when the time period was, but it's only recently they've now discounted people that are on mental health benefits as potentially to be employed. So now since COVID, when we've got mental health galore, they historically would have been classed as unemployed, whereas now they're not because they're not eligible to work.
There we go.
So that skews the data.
Yeah. Did you know over 30% of US American adults are on antidepressants? Over 30%. Sorry? Is that all? Yeah. And they're all armed. Yeah. I mean, to be fair, it's game theory. If I lived in America, I would be a prepper, and I'd have the biggest armory. I would have assault rifles galore all over the house, and it's all about ammunition. If you're a prepper, you can have guns, but it's ammunition. I'd have 20 years worth of ammo. It's just game theory. Why wouldn't you? In the UK, to have that same game theory, the equivalent would just be having a shotgun license and a shotgun, because no one here is basically armed. So, yeah, it's a lot safer living in the UK. So, let's talk about the BOJ. Again, I don't see many people talking about the BOJ. So it all stems back to, and I think Japan is a good indicator of where the world is probably heading. Of all the different, it's a bit like in the Avengers, Doctor Strange, and he sat there calculating the 14 million different ways of how things can play out, and I sit there every day trying to think, could this scenario happen? And I genuinely think the world is following in the footsteps of Japan. Look at how Japan has performed from 1970 to 1992, and then from 1992 till now. So what happened is we had, basically Japan died, and it's in a coma to this day. So interest rates fell, and they've been basically zero. And the whole world, or Europe and the US basically, have followed what Japan have done. So they've seen Japan go to basically zero rates, and they print ridiculously. So Japan have printed way more than the US in percentage figures, not in dollar figures, but in percentage figures. And so what's happened is that there are a lot of wealthy entities in Japan and banks, and people have genuinely gone, rates are so low here, what's the point of investing in the yen or anything in Japan? Let's look elsewhere. So what do? They look just around the corner down into Australia, and they started buying up shit tons of Australia. Because historically, interest rates in Australia were 4%. So it's a simple carry. It's like, that's why Aussie yen is the canary in the coal mine of risk. I've said that the wrong way around. Because they could borrow for basically free in Japan, go over to Australia and just get 4% backed by the Australian government. So it's like, why not? So that's why Aussie yen is that risk on, risk off asset. But what else have they been doing? They've been looking everywhere else. This chart blew my mind away. Japan's huge international investments. They basically put a lot into the US, a lot into the Cayman Islands, and yeah, all over the world really. It started off in Australia, but obviously in recent times it's been more to the west. I mean, how obvious can you be? What are they doing over there? And Japan has had this YCC, yield curve control, which the West hasn't done yet. Whereas the West is like, it's like that meme where, the boyfriend and girlfriend and the guy's looking over his shoulder at that other guy. So it's just like that. So rising inflation right now is already forcing the Bank of Japan to reverse their yield curve control policies, as in keep rates low, print like galore. This means the BOJ will likely start hiking interest rates, and they're already starting to go up. And that's going to not stop, but dramatically slow the amount of capital flowing from Japan to the rest of the world. Japan is holding up the whole global bond market right now, and it has done for the last 5 years. Japan. So what then happens is global bond market rug pull in 3, 2, 1, imminent, technically. And they've already started this stem. So the BOJ sold 5.4 trillion yen of European assets last year. So I think next year or maybe Q4 this year, people are going to start waking up to the Bank of Japan going, holy shit, if the BOJ starts pulling out of the global bond market, that means yields are going to start spiking. And that, I think, could be the little, kidney punch that takes stocks to the knees.